Small room, but packed.
It is packed.
It's crazy. So welcome. Thank you so much. Dave Uffer. I'm the managing director at Trinity Life Sciences. We are a 1,200-person strategy consulting and advisory firm. I'm thrilled to see over 1,200 people at LSI 24. It's the most exciting and diverse conference I think I've seen in a while. We'll have some panelists that are standards here. Every year we see them. I typically will do a panel on corporate development with that history and background. And we went a little different direction this year. I think everybody gets to see what the corporates are doing for acquisitions, but I want to demystify and get a little bit more update on what's happening in private equity, filling such a great part of the ecosystem here in Medtech. In the last 5 years, I think there's more buyers than targets for services companies such as CDMOs. We're tremendous amount of activity in advisory acquisitions, clinical practices, and in the last few years, we're getting a lot more activity in acquisitions with product companies, and strategics serve a certain role. And I want to have our panelists introduce themselves and talk about what their activity in MedTech is. Antonio, you want to start?
Sure. Thank you, Dave, and thank you, everybody, for attending. Antonio Sanchez-Cordero. I've spent the last 15, 16 years doing strategy and M&A in healthcare, mostly with strategics, Becton Dickinson, Thermo Fisher, others. Recently transitioned back to private equity at ARCHIMED. ARCHIMED is a healthcare-focused global private equity fund. We have about $8 billion under management, and we deploy capital out of 3 funds. So we go as early as early profitability all the way to traditional LBOs, and look forward to the panel.
My name's Duke Rohlen, and I work for Ajax Health. We are a private equity firm, growth equity firm that primarily invests in medtech. We have some services, but mostly medtech. My background is as an operator. I sort of fell into the investment side of things by getting to the point where I was a little bit fed up with the venture world. And after a series of companies that we started, grew, and then sold, the vision was maybe we could, instead of selling companies to a large strategic, maybe we could buy the companies that we were going to build products for and build products and basically sell them to ourselves. And that's the genesis of Ajax.
Good. Erich Wolff, man. You're on, yep. Erich Wolff, great to meet everybody or see everybody. So I recently just made the jump over to private equity. Prior to this, I ran global M&A for Becton Dickinson. Prior to that, I ran strategy and business development and corporate development for Medtronic's diabetes and neurosciences portfolios. Joined Partners Group now a little under a year ago, and Partners Group is a $150 billion asset manager. All private markets. We invest across 5 verticals, so private debt, private real estate, private infrastructure, private equity, and we're now doing royalty lending and royalty financing. I sit within the private equity vertical. Of the $150 billion, think roughly 80-ish billion is allocated to private equity. In addition to traditional buyouts, my job, I got brought on to build out our MedTech practice and MedTech initiative. But in addition to that, and I think particularly relevant for a lot of folks here, is we do growth equity investing as well. So we have call it a $250 million per year mandate to deploy across all of healthcare, and not venture. So this needs to be commercial stage, think 20-ish of revenue and growing. We can write check sizes anywhere from 25, 30 million on the low side to 50, 60 on the higher side.
Great starting point, Erich. And Duke told me to keep score how many you get right and wrong. So,
Yeah.
If you see me keeping notes, a lot of folks come to me and ask, should I approach this group? We're raising capital. A little bit of confusion on the different flavors. I think there's a different thesis for if you have 150 private equities. There's 150 different flavors. Antonio, start and tell us about any activity that your fund does with investing, whether it's growth equity or any stage, or it's purely acquisition and buyout.
Yeah, so I think because we are domain focused and we really spend a lot of energy in that understanding really the spaces where we want to invest, we don't necessarily start with the target or with the teaser when it hits the inbox, right? We have about 400 medtech sectors within Medtech that we have defined, that we monitor, that we develop deep dives. So for us, it's about focusing on the segment and then starting to understand sort of the opportunities there, the new technologies. I think in a more traditional fashion, we do think about platforms and add-ons or tuck-ins, and certainly we try to categorize our targets in from that perspective. But certainly, again, I think what we've seen in the industry overall, and again, not going to repeat the numbers for dry powder, but we've become as an industry more flexible, more hands-on, and become a bit more going early. And I think we as a firm, we've also done that, and there's situations where we can come early. Again, early profitability. Or having a clear path into profitability, being able to work with that team, with that investment thesis, continue to bring. For us, a lot of the times it's about having a path to inorganic growth with clear understanding of how we can help the company grow.
Anything to add on that, Duke? From your fund?
Our model is completely different. So what we do is we go and we find what we call a chassis. So a big commercial infrastructure company, the most relevant one that we bought was a company called Cordis, which has just under $1 billion in sales. And we do an assessment of the portfolio gaps in that company. So we'll go in and we'll assess where does this, what products are needed, and then we canvass the market for three things: products that we can license, products that we can acquire, or companies, small technologies that are relevant to the portfolio gaps that we have. So if somebody came to me and said, hey, listen, it looks like you guys need a thrombectomy catheter for Cordis, I would be very interested, because we would then fund that technology with the bespoke intention of buying it from you or buying it back from you at some point. Our whole model is to try and increase the ability for the ecosystem of innovation to materialize, not unlike what Apple did with the App Store, right? So think of Ajax or the companies that we buy as sort of the App Store, and then we go out to an entire ecosystem of people that we know or people that we identify that have technologies or ideas that they could actually bring into that App Store. We don't require them to have any commercial capability. We don't require them to have any financing capability, because we are the commercial chassis. We will buy that, and we fund it. So it's sort of an interesting model. It disintermediates to a certain extent the venture model, because we don't want our small time and our app developer CEOs wasting their time on finance and trying to get money, and it causes a very strange deviation from a value vector when you're focused on the technology, and you should be focused on the technology, not raising money. So that's what we do. And so we identify chassis. We have several of them, and then we go identify people that can build technologies to bring into that chassis.
Segue that we can go in 4 different directions. So I want to start on that one. That's corporate carve-out for Cordis. It was flipped out of J&J, and then you acquired this out of Cardinal Health, correct?
Correct.
So we've seen a lot of activity in corporate carve-outs. Medtronic was looking to divest of their respiratory and monitoring business. Edwards with critical care. Baxter's splitting apart with the renal care. We can go on and on. Are these ones that you get opportunities to see in advance, a preemptive, or you look for these to go to market?
I think we see some of those. I don't know that all of those, but I think some of those, there's some conversations prior to that. I think understanding truly the lack of actionability, right? And because in my experience, it's never a black or white situation, right? There's degrees of gray. So I think it's in some of those that are unfolding. I mean, it's interesting to be able to really think through that, really understand the actionability component, and then how you think about the long-term potential for that asset. So,
Erich?
Yeah, happy to do it. We do see those and are interested in them. So looking at corporate carve-outs make a ton of sense for us. Partnering with folks like Duke and the Ajax team to do some of these more creative transaction structures where you're bringing strategics and sponsors together. I mean, this is Duke's bread and butter. So Duke and I have gotten to know each other over the years, looking at highly creative ways for sponsors to get involved in assets like this and opportunities like this. So, Duke and Ajax have a long-term partnership with at least 1 or 2 large, well-known sponsors, and we're looking to do similar type transactions.
So when we were COVIDing, I would have private equity come to me every month saying, this doesn't look like it's core and strategic to you. Could you divest of this? And we had to be very quiet about that until we made a massive corporate decision. Do you try to be preemptive with companies or wait till they actually are announced?
Yeah, it's a good question. We do. So I mean, I think the punchline for folks in this room and whoever's listening, when you think through interacting with a sponsor, if you're selling a business, et cetera, is there a platform? So is there a management team? Is there a commercial organization? Is it a fully functioning business? When you are a corporate and you're looking at carving out a business, the question becomes, which private equity firms have a platform that this bundle of assets can go into? Otherwise, you've got to really sell like a Edwards critical care business or a Medtronic respiratory and patient monitoring business, holistic businesses that'll expand your sponsor universe of interest.
So that's where I wanted to start with the carve-outs, because you have to have a platform, you have to have a base. Most of the companies here are startup, and they're seeking capital to grow, to accelerate their commercial, and I don't think they're really that core. But as far as add-on, are a lot of your acquisitions growth vehicles for bolt-ons, and are you looking for roll-up strategies, or it's a company bespoke into itself that we're just going to grow this from a different perspective? And we'll get into that.
Let me make one quick comment on that, and then I'll stop talking. But yes, within your platform acquisitions, it is not uncommon to make venture investments or venture stage acquisitions to drive the growth of the underlying platform. So we have a business right now that I'm on the board of. It's called Wedgwood Pharmacy, and we made a acquisition of a venture-backed, venture-y technology platform called Blue Rabbit. So absolutely, private equity firms who are nimble, like we are at Partners Group, are open to that.
I would just add that sometimes it's interesting because it's the bolt-on that drives and triggers the opportunity, right? Sometimes we know of platforms that could be actionable, but it's hard to get excited about that growth profile unless you find the bolt-on of bolt-ons, right? And so sometimes it seems that the beginning of the discussion is always the platform, and maybe that's the easier way. But I find that there's certain areas where we know there's platforms that could be actionable, and it's finding the right startup with the right exciting technology that is growing that could be actually a catalyst for growth that helps us get comfortable with the story for the platform. So it doesn't always work one way around.
Duke, when you're looking at just that individual asset to be your start, I hate to use the word distressed, but is a lot of times these are a distressed asset, or is it something that is non-strategically aligned with the management, or sometimes a management turnaround that, okay, we're going to come in with our management team. We think it's got a great base, good technology that we can grow. They're just not growing in the fashion that we think it could.
Yeah, I mean, I think that, first of all, carve-outs are really hard. It took us 2.5 years. We had hundreds of TSAs that we had to retire. I think it cost us like $150 million to separate Cordis from Cardinal. And the TSAs went all the way back to J&J. So this is an asset that's been starved of attention. I always think of it as a house that's overgrown. It's sitting on the cliff looking out at that beautiful ocean, but you can't see the ocean because it's so overgrown with vines and rot. So our job is to come in and make that house pretty again, right? And when we bought Cordis, what I loved about it, it was anemic. It was growing like maybe 1%. It was barely profitable. It had, we were in 48 countries. It had 4,000 employees, totally inefficient, totally unproductive. And our vision was that with new management and with a new focus of growth, we could go and transform that company. We're growing now just under 10% in 3 years. So it's like a remarkably fast growth projectile. And what we've done, and this is where I think you're getting, our thesis is that we can go surround that asset. We can surround Cordis with innovation. We created an entity with $300 million called Cordis X, and Cordis X is just pumping products. Every 6 months, we have a new product that's coming into Cordis, and it's just like systematically increasing the number of products, the differentiation of those products, and therefore the revenue. So we're revitalizing something that's really been broken. I think it's really hard to try and make sense of a company that's just doing really well. It's a little bit like buying a fixer-upper versus buying a house that's beautiful. But the house that's beautiful, you might want to live in, but it's not going to increase in value like the fixer-upper will if you can figure out how to affect the inputs to change that and fix it up.
Look, everybody has to report results in some way, but talk about the advantage of not being public and having to worry about each quarter earnings per share and shareholders and the ability to actually invest when right now might not be the best time on the bottom line, but for the growth of the organization, we're not going to be worried about shareholders and our price.
Well, we are public, so no, I mean it's nice to be outside of the quarterly cycle that all of us I think have been. We've all kind of worked together in some capacity up here, so it is. It's a very different world where you can invest for growth. You can make investments today that don't need to pan out for the next immediate quarter to get the ROI you need to justify it in that period. So it is. It's a really it's a strong benefit of being focused in private equity.
Yeah, no, I think it makes sense. I think the ability to make the right decisions because you can take a longer perspective, and again, longer meaning a year and a half, 2 years, right? Not the next 2 quarters make a huge difference. I think just back to the carve-outs and sort of connecting both things. I think the other opportunity here is in partnering with strategic with listed companies is there might be segments that are sort of could be a carve out, but they could be strategically long-term relevant for the strategic, right? They just might not have the priority, the bandwidth, might not have the ability to deploy capital and build it up in the next 2, 3, 4 years. So I do think there's an avenue here for areas that are strategic, but not enough to make it to the top 3 where the capital gets deployed, where new acquisitions get done, or they might be dilutive in getting there. And so I think I'm seeing more interest in having those conversations. And then part of the challenge is how you structure in a way that makes the corporate comfortable, that ultimately they can take that back, and you can get very complex. But I think that's an area that we're going to see private equity step up and help consolidate and help build some of those.
With the uncertainty in the, I want to say a little bit of the sour market for IPOs. We all understand what the IPO market has been in the last 18 months. And I think the bankers used to be great about putting their finger right on the time when it was going to open back up. And I think we're just a little too much uncertainty now. Does that create great opportunities for private equity to fill that gap where companies have another alternative to actually capitalizing the organization?
So I think great companies go out in some way, shape, or form. You target what we call liquidity optionality, and you work towards an endpoint where you have multiple ways to liquidate the asset, and you then at that point decide if you want to do it, right? Do you want to raise money? You do that from a position of strength because you have some other BATNA that you can deploy. I think that the job of a CEO, quite frankly, is to raise money and then get a return on that money. That's it. So a lot of people think the job of the CEO is to manage the technology or to manage the people. Those are side products to the value creation initiative and role of a CEO. So when we look at a company and we take a 4-year timeline, we say, okay, how are we going to liquidate that company? How are we going to sell? How are we going to monetize that asset within 4 years? We cannot rely on public markets, right? They're just not there. So you have to think of different sources of liquidity, and those can be partnerships, those can be roll-ups, those can be funding from private equity. You can sell the private equity, you can get growth. You just have to figure out how within that period of time you're going to create value. If someone came to me and said, listen, here's my plan, right? I'm a really good operator. I've got a track record of success. In the next 48 months, I'm going to do X, Y, and Z, and here are the options that I'm going to have when I complete that 48 months. What I would diligence is the probability of those exits, how discerning he's been in terms, or she has been in terms of understanding and being real about the liquidity. And by the way, if I got comfortable with it, I would make that investment, right? Sort of irrespective of some of the details like managing people and building a technology or building a product. we start with strategy, and then we back up from there. And the strategy is defined by how do you create liquidity.
Yeah, I was just going to add, I think in our space, particularly I'm more focused on medtech and diagnostics, I think the window's being closed long enough that it doesn't feel it's a sort of, it's competing for as an alternative at the moment. And yes, it will open eventually, but I think that's less of a concern. I think the other side of that is we've seen enough, enough challenges in the equity market that we're seeing opportunities there as well, which is the to P2P, to public to private. And I think we expect more of those opportunities where the market is not really recognizing the value in the asset, and we have an angle and we can come in and we can help that team continue to grow the business and continue to execute on their thesis that was challenging to do in the public market. So I see there's going to be more opportunity in that space as well.
I would add one more thing, which is I think the viability of having a single product med tech company that's public, those days are gone, in my opinion, because there's a flight to profitability. Everybody has to show how this thing is going to create money. It's not just going to be a public company that has hope. There's got to be a path to making profit. And single product companies that are in the medtech space are really challenged because they don't have enough money to diversify their portfolio. They are spending a ton of money on sales and marketing in order to drive revenue there, and they basically take away the acquisition premium over time, right? Because even if you're really selling a lot of products, if you're not profitable, nobody's going to really buy you. There are exceptions, but like when I ran Fox Hollow, we got to 200 million in sales, and we had a really important question to ask. Were we going to diversify and become what I call a consolidator company, or were we going to sell the company? And we ended up having to sell the company, and we were lucky. I think we were one of the last ones to sell. We sold it for like under $1 billion, but there were so many mistakes there. So I don't think that the public markets are a good source of long-term liquidity for investors or management, because I think they go up and then they come down pretty fast unless they can figure out how to bolt on other products to their sales infrastructure.
I would agree. And I would just add on, just in the spirit of clarity, having been on kind of both sides of the buyer aisle, what Duke is saying is exactly spot on. So if you're taking a look at as a strategic buyer, so you're a Medtronic or a Boston or whomever, you either have to have massive amounts of synergies in the middle of the P&L to drive that non-profitable single product company to be accretive to large company financials, right? Or on the private equity side, we're an EBITDA-based, acquirer. And so it doesn't cut either way. It doesn't work either way for being an ultimate buyer. So Duke is exactly spot on. You'll see them skyrocket, and then there could be something like GLP-1, right, coming out, and you just watch everybody, every single product company that has any tangential impact of GLP-1, their stocks plummet, right? And so you're very much at the mercy of the markets.
So you talked about single company IPO, single product company IPOs and so forth. I can't help but throw out the landmine. A few years ago, we saw a lot of SPACs coming here and talking. Antonio, you're smirking. Comment what you think of the SPAC option, and we've seen a lot of different activity there.
I don't know. I mean, I think we have some fashions, that come from a finance perspective, that it's a different way of doing things. But I think ultimately, and I think Duke was alluding to it, the value creation opportunity is what it is. The challenges of scaling up, particularly commercially in our space, are very difficult. And I'm not sure there's a way financially to do it that it's going to solve for that. So I think we saw that skyrocket and then sort of kind of go back to earth as probably as fast, if not faster, than the way. So I don't know.
I think every large strategic dabbled in at least investing in at least one SPAC to see sort of how it worked out, and I don't think anybody was particularly successful.
Look, I love diversity in our market, but I'm a medtech snob. So the thing that I love about this, and that's all I've done for 35 years. So what I love about LSI, it is a medtech only in specific conference, and we are a very different part of the industry. And maybe SPAC was good opportunities in different parts, but I think we're all talking what suits medtech, and it's a very different area to participate. Little bit about, Duke, you started to talk about management teams. People are, let's demystify that. We want our own team in there. We're moving everybody out. We don't think these are aligned with our vision, or we love the management team to stay there. That's the stability and different flavors.
So we love the management teams that are in the companies to stay if they are capable, right? It completely obviates disruption. It's a nice continuity from the old owner to the new owner. The challenge is that in order to change the direction of a huge ship like Cordis requires a different phenotype of person, right? So someone who's been at Cordis for 20 years might not have the energy or the fire in the belly to put in the really hard work to align with the vision of what you're trying to create for the company. And those people sort of self-amputate. It turns out that they're not a fit. They know they're not a fit. They want to do something different. So at Cordis, we replaced everybody. Unfortunately, the whole management team over the course of a year was changed out. Most of those people left on their own initiative, though. They didn't like probably me or the intensity that we brought to the table. But now I have a bunch of people that have worked with me in the past. I pulled them from various companies that I've run, and it's a really rock star team. I would say, though, one of the things that we do a lot is we look for people outside of medtech to come in to medtech companies and bring fresh perspective, fresh ideas, et cetera. So one of the things that's really rich about healthcare now is it really involves services, and it involves big technology like Apple and Google, and we're talking with Microsoft about a company. And what you're getting is these fresh ideas coming into medtech and really disrupting a calcified industry. Our medtech space has not innovated on the model in a long time like other companies have. Biotech is way more creative, right? Software is totally creative. And so what we're doing is trying to bring those outside people, those outside ideas into medtech. And I think there's going to be, this burgeoning of innovation because of that. My final comment is that the one thing that's clear as day is that these big companies that are earnings per share focused, the big incumbents, absolutely have to have growth. And they're not going to always get it by paying a lot of money for it. So figuring out how you can get people and ideas to create on a business model that allows for innovation to go into those big companies with less risk for them from a financial standpoint, eliminating some of the earnings per share dilution issues that are challenging. It creates this unbelievably interesting opportunity, I think, for new innovation in medtech.
Just to build on that, I think following Duke's use of a capable management team, for us, putting carve-outs aside, that's a key criteria in looking at a company. I think what it gets interesting is what we can bring to the table in terms of the next phase of growth of the company. And sometimes it's challenging some of the assumptions about how the business should grow, particularly when you have resources that the previous team didn't have, right? So enable that sort of inorganic growth component of the conversation. That tends to be a conversation that hard at the beginning because that management team might not necessarily have spent a lot of time on thinking from an acquisitive perspective. Yeah. But I think enabling it from our deal flow, from our database of companies in the space that we think could be a great addition, I think that's where it becomes a very exciting conversation. And I think the management team recognizes that. And I think that's been a partnership that has worked very well for us.
I think that's right. I mean, management team, doing due diligence on management teams is, critically important. We look for nimble entrepreneurial leadership teams, right? At Partners Group, we have a really, unique and I think best-in-class operating governance model where we bring in outside advisors. We call them operating directors and lead operating directors to really take meaningful and meaty roles on our boards. So they are actively engaged with the management teams, helping bring in industry expertise, having steady contact with the leadership teams versus just sort of quarterly board meeting report outs. So it's a very, I'd say it's a very nimble and entrepreneurial approach that we take to board to the governance of our portfolio companies.
Nice. Which ponds to fish in? Are you thematic when you look at particular market segments or technology segments, or purely agnostic, a great business that we think we can grow and profit and add on to?
We are, and I know you're going to hear the same thing from Antonio. Not all private equity firms have the DNA that our firms do, but we are highly thematic in our research. So we do deep dives in every single space, every subsector, every category, and are far less reactive to just some random asset comes up for sale, and we're going to go spin up our deal models and see if we can make the financials work. So it's a very pragmatic, very thoughtful approach to our investment.
Well, I want to hear from each on that, but is that because of certain segments that you think are very high growth potential, or because your team has more expertise in that and it fits with your ability to assess and operate?
Yeah, I mean, I would say that the filters that you apply to markets start with that, right? So you're going to look for high growth markets. You're going to look for markets where you can make an impact. There's assets that can put you in a number one or number two leadership position, sort of out of the gate. I think that's the most that's one of the initial filters that's applied. But then, yeah, specifically, where do folks in the organization have the greatest skill set? And you'd be blown away by the level of rigor and caliber and advisor networks that are brought in to help go deep in a sector or subsector. I got brought in. There's a lot of private equity firms, I think, that are becoming increasingly thoughtful about bringing experts in from industry into the private equity firms to help drive that depth in the thematic research. So I expect that trend to continue.
Yeah, it's similar, right? Thematically, we do have areas. I think back to your second question, Dave, I think it's about a combination of both, right? Certain segments that are very attractive, and then certain areas that our team is particularly, familiar with, that have a deeper network, and so the combination of both tends to be great. Because we're sort of fully focused on healthcare, but we do everything from bioprocessing services. Medtech, diagnostics, healthcare IT. I think what it's interesting for us is, first, when we have those early conversations, we've already sort of declared that we want to enter that space, or that we want to continue to invest in the space. So we know the space. The conversations with the companies, with the management teams are way more interesting because we know the space versus we just learn about that company and now we're going to start the process of getting to know the space. But the second piece is because we cover the whole spectrum, I struggle more and more to find opportunities that belong only in one of those buckets, right? Most diagnostics companies now, they have a heavy healthcare IT component. And a lot of the diagnostics companies have a big, life science component, because the technology is also used for research somewhere. So I think, we work across those buckets. Driven by some of those areas, but at the same time working across those areas, because I think that gives us a better perspective, more conviction in a lot of these opportunities.
Duke, your history is legendary in interventional medicine, but again, thematic, beyond?
We are thematic. We differentiate between strategic and opportunistic. And so there are areas that are strategically interesting to us, but then we have to be opportunistic about taking advantage of them when they come up. So you're not going to go, spend $1 billion on something that just pops in your lap. It's going to have to make sense based on what you know, or who you know, or how you can change it. And a lot of that depends on what you've done historically. So yes, we are thematic, but we try and be as strategic as we can, knowing that opportunism knocks and sometimes you have to jump on it. For example, we're doing a lung cancer deal with Hologic, right? We're creating a new division for Hologic. And I've never done anything with lung cancer in my life, right? But so that's a little bit more opportunistic, but we understand and we can build the capabilities to make it strategic, if that makes sense.
On that creativity, Erich, back in the Medtronic days in diabetes, you had done something with private equity, very creative as well. Talk about some different models to be very creative with. private equity?
Yeah, happy to do it. So years ago now, we at Medtronic, I was running the strategy and business development team for our diabetes business, and we had multiple programs that were either underfunded or non-funded that we viewed as being absolutely critical to the future of the enterprise. And so we made a whole bunch of trade-offs within our portfolio, and we decided, listen, we would like to augment the funding of these programs to accelerate them, et cetera, and partnered up with Blackstone Life Sciences. So Blackstone has a royalty investment group largely focused on pharma historically. I think we were their first medtech deal. But effectively what happened is we brought in private equity money to fund these programs, keep the employees within the strategic, and if the program was successful, a royalty on those products was paid out. And if the program was not successful, the private equity firm took 100% of the risk. And so when you take a look at that kind of creativity, it's P&L neutral, meaning it doesn't impact, the profitability of the division. It shares the risk, right? So you're paying a royalty, so you're paying, dollars on every single unit you sell to an investor, and they take the risk of their investment going to zero, and you, of course, take the risk of not having the product that you very desperately want that they're funding. So very, very creative types of transaction structuring out there for private equity firms to partner with strategics.
Thanks, Eric. So many people ask me, are we going to get into so many different topics on the panel? I will reserve the last few minutes. I do want to ask anybody in the audience that just raise your hand if you want to ask any of the panelists a question. We can't get to every topic. The last one I want to get into is geography. Antonio, you have the most diverse geographic footprint up here. Talk about geographic considerations for you.
So we've got offices in New York, Lyon in France, Singapore and Tokyo, and truly we think I think any of the spaces in healthcare, well, most of them are truly global, right? Same portfolio, they're sold differently, commercialized differently, but into every geography. So we think, a lot of our energy is spent right now in US, Europe, and Asia, and so definitely we don't have a strong priority for one geography over another.
And that's where the companies are commercializing, where you look for the opportunities, or basically where you source them, or whether you continue to operate them?
Yeah, both, right? They can be, they're sourced across all these geographies, and we would expect them to, they can operate in any of those geographies. And sometimes, particularly for the European-based ones, what we can also help is with internalization, particularly sort of arriving to the US, landing in the US, expanding their presence in the US in a more strategic way.
Duke, for Ajax?
I wish there were a company in Dana Point, because I'd buy it, even if it wasn't a very interesting company. I think it's a great place. Okay, I love it. That's great. No, just like the whole idea, you got to be strategic and opportunistic. You got to go wherever the company is.
Yeah, we're in the same camp.
Okay. Anybody from the audience, please?
Happy to start. We have a very extensive network. Because we are domain focused, we really value, and we see as most of our teams are made up of executives, scientists, investors, and operators, and so that makes is something, from the get-go, our managing partners is a diverse profile. We have different sort of layers in that model, from a strategic advisor, strategic partner, operating partner. There's limited differences, have to do more with exclusivity and dedication. But I think the point is we like to build long-term relationships. We like to build relationships where that person can be part of the assessment of some of the deals he or she might be sourcing, some of the deals that we might be sourcing, and that relation continues, and sometimes it deals to executive roles, sometimes non-executive roles, and so it's a fairly, it's well entrenched in our operating model to have people from the outside, advisors that can join our team, and they're part of the team from the day one.
I would echo that. We bring advisors in at the beginning, so anytime we're taking a look at a space, out of the gate, we'd have interest in the space, but then bring in advisors to help build our thesis, right? But also challenge us, right? So we bring in sort of red hat or red shirt advisors as well to push back on us, pressure test our assumptions, because at the end of the day, we're focused on building businesses that have winning business models, right? And so with that, you've got to understand where all of the challenges are, beyond just the opportunities. And so we have a very strong advisor network, and like Antonio, they can play various roles of increasing responsibility in our portfolio companies, all the way up to sitting on our boards.
Duke, most unique opportunity in Medtech to get the last word in after Erich. To get the last word in after Erich, anything to add there?
No.
Thank you.
Thank you very much.
No was the last word. Thank you very much.
Yeah, appreciate it.